Okay, we have the next panel, and I'm going to be moderating that panel. So I'd like to ask my panelists to come on up. And if we can get the senator from Philadelphia to join us, that'd be great, coming up here. Just kidding. Again, everybody, good morning. My name is Greg Johnson. I'm the CEO and founder of Rubicon Digital Assets, Rubicon Crypto. As we're taking our seats up here, and I'll probably stand while I'm doing the moderation, but please have a seat, gentlemen. Just something to keep in mind. One of the things that's interesting about the fintech space right now is the moment that we're in. And I don't think there's any hyperbole whatsoever when I make the statement that we're having a chat GPT moment right now in fintech. And so most people, when you go back for Thanksgiving after chat GPT came out, everybody was an AI expert, everybody was talking about AI, everybody knew something big was happening. Well, on July 18th, in Washington, D.C., with the stroke of a Sharpie and the signing into law of the Genius Act, that is the chat GPT moment for fintech. What it meant was anybody that was in denial as a major institutional player had to get with it and start learning and come to the table. What it meant, and what has not happened yet, is every entrepreneur in fintech, every small to medium-sized enterprise in fintech now needs to catch up. If you've been avoiding this topic and avoiding this conversation, with one stroke of the Sharpie, that all changed. So joining me today is an incredible panel of subject matter experts that I get a chance to moderate this conversation. First of all, from Coinbase, some of you may have heard of a small company called Coinbase in the crypto and digital assets industry. Nick Carden is joining us. He is a director and associate counsel for Coinbase. Also, Cesar Pereira, who's joining us from the tokenization side of things, who's a VP of Business Development and Sales for Cadena. And also, we need to have at least 2 lawyers for every panel here at Fintech South. So Jason Nato is joining us and providing his perspective on this very, very big and emerging industry. You know, I teed it up a little bit, Nick. I'll go to you first, but I teed it up just a little bit about this whole Genius Act, and it was a pretty big deal. And you've been in the industry. Do me a favor. Maybe you could set the context for what's going on in D.C., the Biden versus Trump administrations, their approach to digital assets, many of the themes we're going to explore. Thank you.
I like the way you teed that up.
All right.
Chat GPT moment. Okay, so we're certainly in a new world, a new political world under the Trump administration. The Biden administration they weren't, I don't know if they were anti-crypto, but they certainly didn't do the industry any favors. I mean, we saw this in 2 primary ways, and maybe this is really anti-crypto, but not officially anti-crypto. You saw Operation Choke Point 2.0, which, if you're familiar with Operation Choke Point 1.0, it started under the Obama administration as sort of this unofficial initiative to keep unsavory industries out of the traditional financial system and institutions. And then the Biden administration decided that crypto was part of those unsavory industries. And so what they would do is they would have your banking regulators come in and do these secret exams, and it was painful for the banks. And so instead of keeping crypto as clients and keeping their deposits, they decided that the churn really wasn't worth it. So that's what I mean by sort of an unofficial initiative, and they would not publicly put the pressure on the banks, and that sort of came through once crypto was part of that those unsavory industries as Choke Point 2.0. And we have an exec order now from the Trump administration that basically says you can't deny banking services for, amongst other things, lawful business practices. And unless I'm newly mistaken, as of this morning, crypto is still a lawful business practice in many ways. So that was sort of one way that the Biden administration and now the Trump administration, we've seen this sort of compare and contrast. And the other way is with SEC enforcement, which of course regulation by enforcement under Gary Gensler over the past 4 years was kind of the headline there, and they brought 125 crypto-related enforcement actions. They had 50 lawyers and staff devoted to crypto enforcement.
Many of them here. Many of them here in Atlanta.
Yes, that's right. So Coinbase was certainly the target of one of those enforcement actions. We were allowed to go public. The SEC knew about our business model in 2021, and then in 2023, we were told, actually, your business model is an unregistered exchange, which is very, very strange to us. So we fought that case, and certainly earlier this year, that case was dismissed with prejudice. But a lot of those cases brought against Uniswap, Ripple, Binance, Terraform. You sort of the names and the list go on and on. And some of those maybe were warranted. I'm not going to say they weren't, but some of those cases settled, and maybe they didn't have to settle. I suppose if they had waited a little bit longer or fought a little bit harder. And now you've certainly seen under the Trump administration a new SEC enforcement regime where Hester Pierce, one of the SEC commissioners, has said that prior enforcement actions were based on legal imprecision, and I think that's a good way to frame it.
Quote unquote. You know, I got to think, even in a candid moment at a Coinbase offsite retreat somewhere in the Maldives, I don't think anybody saw what happened coming to this extent. In fact, I don't think it's any hyperbole to make an observation right now that there's never been an industry, meaning crypto, that supported the outcome of a presidential election and has received so much, so quickly, so deeply, so broadly than the crypto industry. And what that means for people in this room, if you're adjacent to fintech, is you need to lean in and catch up quickly, like many of the clients of some of our panelists that they're experiencing right now. Also, one of the hottest topics that is literally having a massive disruptive impact on fintech and traditional financial services, the notion of tokenization. And so I want to turn the next opening salvo, Caesar, to you, and to talk a little bit about RWA tokenization, how your firm sees it, some of the work that you're leading, if you don't mind, before we go back to the lawyers.
Perfect. So I get a very fortunate, privilege to sit in a seat where I can see what's happening globally from a tokenization perspective. We spend a lot of time talking to institutions, and I focus predominantly on an enterprise traditional institution on their tokenization strategies. And to Greg's point, everyone talks about tokenization, but when someone approaches me and says, I want to tokenize something, a real-world asset, I'll always say, why? So what? Like, why do we want to tokenize something? Like, what's the benefit? What's the utility? And when you think about it and you start peeling back the layers, when you tokenize a real-world asset, what you're really saying is you're improving the velocity at which that asset can move, right? So think about collateral as an example. Today, a very inefficient process where you want to move collateral. By putting that on chain, you have the ability to move that instantly, limit your risk, et cetera. So for me, tokenization has been this, buzzword, but we're seeing it happen. And to Greg's point, institutions need to adopt. So the idea that, we can tokenize anything, and we're seeing predominantly opportunities in Europe. The U.S. has kind of lagged, but I think now with the regulatory clarity, we'll start to see that shift, significantly. But Europe and Asia, we're starting to see quite a bit of tokenization. And traditional institutions do need to take notice. And, silently here in the U.S., we have a number of, large financial institutions that are adopting the tokenization strategy, whether it's the BlackRocks or the Franklin Templetons of the world, tokenizing U.S. Treasuries. But things like private credit are being tokenized, U.S. Treasuries, private equity, real estate. These are all things that we're seeing evolve. And there's tremendous benefits to the tokenization of those assets because, again, you're improving how the velocity of that asset and money, travels globally.
Thank you for that. Jason, you have an interesting seat because you're working with institutional clients and TradFi. You've been working in legal solutions for emerging businesses throughout your career, really. But right now, where you're sitting, talk to us about what you're seeing in terms of how banks and other financial services institutions are reacting to this immediate and stark, swift change in direction.
Sure, Greg. So thank you, everybody, for being here. And such a pleasure to speak with Caesar and Nick. And before we get started, this is why we have two lawyers on the panel. Nick, I can confirm that crypto is still legal as of this morning. But with that said, it's excitement, eagerness, and also a little trepidation. And the reason I kind of put all those together is, going back to what Nick was saying with Operation Choke Point, you boil that down into one word, it's debanking. So for a long time, banks have been told, can't be doing business with digital assets customers. And that's like the language, we call it crypto, but that's how it is in their regs. And you have regulators like the FDIC and the OCC that are really like, looking and making sure, kind of like when the cops pull you over and like they have no reason, it's like, okay, can we just get the dog to like just sniff around your car for like no reason? Well, it's like kind of like that's like the regulators where it's like they're like looking, trying to like find this, and that's like those were the steps. So you have these banks that have been told, no, 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 and they've been conditioned, don't touch it, don't look at it. But then you also have now this messaging that was just coming out, and I was speaking with like Rodney Hood of the OCC when he's now with the Fed for Atlanta. But right, you guys should be really lucky to have him down here because he's fantastic. Anyway, I was talking to him in April when he was the interim comptroller, and where the OCC now is coming from is that it's about risk management, not risk avoidance. And so getting a bank to kind of accept that, and some are going to be more willing than others. So they come to me and they're like, can we really do this? Yes, going back to my disclaimer for Nick, it's legal. And then you also have, to Greg's point, now you have an administration that is, I mean, nothing I've seen, just like Greg, where it's like, you've seen nothing shape an election like crypto has before. And this administration is delivering on that, and just the expediency and the speed that these orders have been rushed through. Well, banks don't really move that fast, newsflash. So it's like, so now they're kind of like having to shift their thinking, and they're having to shift, like, can we really do this? And where they come to me, and when I advise them, is like, yes, you can do it, and here's how. And this is where the things get a little tricky, because we're still kind of building the plane as we're flying it, and you have some banks more than others that want to like, let's just do it, let's get in it, because there's opportunities to be had, and also the reality is we can't turn them away anymore. So now how do we prepare for this? So a lot of it is going to be, where I'm helping is policies, procedures, shaping the regulatory environment, and scaling. So bank A, you want to take maybe a step back, you want to kind of do this slowly. Some of it is fear, some of it is resources, but then you also have bank B, where they see more like opportunity. Like, so then how do we get there? So in my role, having to balance that and having to acknowledge like, okay, bank A, let's take it slow, here's how you can do it, and here's how you can kind of dip your toe in the water. And then when you have bank B, it's like, well, here's how we can get there. You have digital assets customers that are lining up. They're going to be coming to you. They're already coming to you. And they're already asking you questions about this little thing called stablecoin now. So like, how do you make all this work together? So to answer your question, Greg, is the way that I'm advising and the way that I'm helping is that I'm trying to focus in on kind of what Caesar was saying, trying to get to the why. Why do you want to do this? And then I get to the how, and how do I get you there? And lots of opportunities, very exciting time for all of them.
What you said just reminded me of a conversation I had with Bill Dudley, who's the chair of the Bretton Woods Committee and was the former head of the New York Fed when all the fun stuff was taking place after the great financial crisis. And he said, when we started seeing some of the crypto bank runs from a couple of years ago, and OCC and Michael Sue was involved in that before Rodney came in. But the reality is, he observed, we always had the weekend. Well, you don't have the weekend anymore. And you don't even have the afternoon. You don't have the overnight. And while the narrative is true that banks have traditionally moved slowly, if you don't move, it's going to be at your own peril. And I say this somewhat in jest, but there are more grandmothers in Caracas and in Buenos Aires that are fluent and better prepared to work with a treasury function that has a basket of currencies than the existing Fortune 500 treasury function today. That's a fact. They're more fluent, more comfortable working in that type of an atmosphere where it's multiple different currency solutions to run a treasury, to run a business. And I think that's an important distinction. So I want to kind of do a little forward looking, if I can, with each of you gentlemen. As you see the landscape over the next 6 to 12 months, get some bold takes, some spicy takes. It's morning here at day 2, Fintech South. Let's get some spicy takes about kind of, what's the conversation going to be? What do you think we're talking about maybe at FinTech 2026? We'll leave it a year out, make it easier, okay? And then not everybody at once, but go ahead, Nick, if you want to jump in first, and we'll go around the horn.
Sure. I'll say I'll give you two takes. One on the policy front. It's no secret, we talked about how the crypto industry shaped the presidential election in 2024. The crypto industry will continue to do that in 2026 midterms. Fair Shake, the crypto industry-backed super PAC, still has over $100 million in its war chest in preparation for the midterms.
Did you hear that? $100 million in a war chest.
Yeah.
It's not going away. If you leave with anything, it's not going away. You picked the right track to sit in on this morning.
Yeah, it's really bad business to be anti-crypto, and it's not just okay to be neutral on crypto. Fair Shake is going to force politicians' hands to be pro-crypto, and so as much as we've
What's
seen...
Fair Shake, Nick? Just there may be some people who are not dialed in as much, but what is Fair Shake?
Fair Shake is just a crypto industry-supported super PAC. Super PACs are highly influential in the U.S. federal government elections and system, and also state politics as well. Yeah, supported by large names in the industry, including Coinbase, Ripple, the Winklevi twins, Gemini, all sorts of other players.
No comment.
Yeah, right. The other hot take is it has to be stablecoins, and whether banks are going to issue their own stablecoins or they're going to have sort of this interconnected sort of big bank stablecoin, and what they're going to do with it. We had Genius pass. That was great. It prevented exchange like Coinbase, exchanges like Coinbase from issuing, well, not from issuing, but we don't issue tokens, but from offering yield and interest on those stablecoins, effectively because the bank lobby really worked hard to protect their moat. But at the same time, that moat is kind of porous, and so there are still ways to give rewards or quote-unquote yield to that. And so the banks are thinking about how do they protect themselves from this potential loophole. Are they going to change Genius? Are they not? But I think the point is the banks probably have to figure out a way to keep their business model, and that model is give me your deposits. I'm going to give you very little or nothing in return while I keep sort of that interest. And that's a great business model for banks. It's not great for consumers, and that's why I think banks keep stablecoins far away from their model, unless they do their own stablecoin, which makes a lot of sense for them because they can, again, if they're going to keep their reserve assets as T-bills or other sort of government-backed treasuries, they can keep that interest just as they do with a savings account or other type of deposit.
Yeah, that's a terrific observation. Not all banks have been, waiting, and in fact, there's going to be a terrific fireside chat next that Prakash is going to be leading with the CTO for Connexus at JP Morgan, and while their CEO has very adeptly kind of balanced both sides of the conversation, crypto sucks, but we're interested in blockchain and we're interested in tokenization, they've built arguably one of the most impressive infrastructures in this space. So some are leading the way and others will in fact be left behind. Cesar, you mentioned something. I'd love to get your hot takes, but go back to the why also in your next salvo, if you wouldn't mind. You went Simon Sinek on us and begin with why. But I'd really love to get your hot takes on where we are a year from now with tokenization, maybe a headline or two, but also you mentioned the why, and I think I understand, but maybe go a little bit deeper on the why, and especially on private credit, which that's the sexy topic now in tokenization. I'd love to hear more.
Yeah, definitely the sexy topic. On the hot takes, I won't talk about stable coins. I think Nick has done a great job there. But on the tokenization front, I think, as of earlier this week, we were approaching somewhere around 26 billion in tokenized assets of RWA. I see that number over the next 6 to 12 months increasing to in the multiples of trillions in terms of tokenization. And the reason being is that, I don't know if anyone here has been keeping up on the news, but we always hear TradFI converging with DeFi. This past week, we saw for the first time ever an intraday repo done on a Saturday. So this idea that TradFi wants to trade and move money 24/7 is happening, and it's going to happen very quickly. And once that happens, we're talking about unlocking trillions and trillions of dollars of tokenized assets globally across the markets. So
it's amazing. Still not convinced. Go and take a look at DTCC. which is the largest financial services institution you've never really heard of, probably